Good morning and welcome to Join the Dots. We're not going to call it Saturday today, we're going to call it Staturday because I'm going to give you some very important stats. I know they're boring, but let's explain them and then you can check them with the links that I'll send you. Okay? Now, on Friday we saw a very high PCE, which is the preferred measure of inflation for government, for the US government. We saw a high inflation reading and the biggest rise in 4 months at 0.3. A lot of people are panicking on that, and a lot of people are saying, this is it, this is the beginning of the explosion of tariff effects. I still don't see that, okay? I might be in a minority here, but I don't see it. I see it as, yes, inflation is rising because food's rising. I've shown you that. All around the world, food is rising. But I don't think the tariffs are really being passed on. And if they are passed on, I don't think they will hold because basically the retailer won't sell anything. So the retailer has to fight the distributor, who has to fight the importer, who has to fight the exporter to absorb those costs because the consumer won't pay them. So let's go into Saturday. All right. The first link I'm going to send you is from our good friend Jeff Schneider at Eurodollar University. He's very good at doing the data. He's very good. He's very good at examining it and analysing it and giving you some thoughts on it. Okay? And the first minute of this link is really critical because it's all about what I've been talking about a lot before we went into the macro Japan, China. Okay? I've been talking a lot about house prices and I've been telling you that the employment situation is what is going to drive house prices. People are worried about their jobs. They're not only not getting a wage rise that equals inflation, real inflation, they're not getting that. They've got job insecurity. They're not sure whether their job's going to be there in 6 months, a year, whatever. And this really hurts consumption, okay, because people get scared. Now, the first minute of Jeff's link, I think, is very good for you to just listen to. Just listen to, maybe the first 2-3 minutes. Just get the feel, because it's very important that house prices are falling for the last 3 months across America, okay? And that people are feeling insecure in their job, which means they're not going to move house, are they? They may move down if they can find a buyer. There's not many buyers, that's the point of the surveys. Okay, so we've got problems that Jeff mentions in the first few minutes of his presentation. He mentions the link to 2008 and I keep seeing it and I'll keep showing it to you. You will see since 2007, since 2008, since 2007, you'll keep seeing that expression or hearing it. And that should just ring a bell, shouldn't it? It should say, uh-oh, we've got problems. Okay, so have a look at that. Have a look at that link, please. And then we'll move on. Now we come to rental car payment delinquencies. This is important because an awful lot of people use rental cars. Okay, it's when they can't afford one. Why do you rent a home? You can't afford one, so you rent it. Why do you rent a car? You can't afford one, so you rent it. All part of that big plan to get everyone to have nothing and be happy. No, I don't think so. Anyway, rental car delinquencies are now up. And the 60 days and over delinquencies are the worst since subprime, 2008. There's a link there to Axios report on this, so please open that link, have a look if you want to delve deeper. If not, take my word for it. That's where we are. Now I move on to really official data coming from the Fed, coming from the FRED system, the Federal Reserve Economic Data, I think it stands for. This is from the St. Louis Fed. And it's you can go into the St. Louis Fed and get all this data in one report, but I'll break it down for you. Let's look at the key areas. Delinquencies on consumer loans to all commercial banks, so that's all commercial banks across the country. They are now past the level of Q1 2006 and they're rising, okay? They're now at 2.93%. It doesn't sound a lot, but it is, because the peak, the very peak of delinquencies in the 2008, 9, 10 series at subprime was 4.5 and they're already at 2.93. So they're on their way and the trend, the journey, remember that word, the journey is that way. So they're not looking good. There is a link to delinquencies consumer loans from the FRED. Then we move on to credit card loan delinquencies. These are rapidly increasing. Now, the biggest problem is that in the smaller banks, in the smaller regional banks across the states, this rate has reached 7.8%. It is a very high level. And you have to remember that these are the same banks that are absolutely smashed with commercial real estate. Because regional banks tend to be the lenders into their cities, their towns, their counties to commercial real estate. It's their market and they do it. It's not your Morgans, your Cities, your Wells, it's not them. It's the regional banks. And these people have massive problems with commercial real estate loans. Well, now they've got another problem. Credit card loan delinquencies, 7.8%, higher than in 2008. Ooh, not good. Credit card loan delinquencies at the larger banks, the top 100 banks, are actually smaller. They're actually a lower number. And that's at, we're now at we're up from 1.5% to 3%, and the peak was 3.93 in quarter 2, 2007. So again, we're heading into that subprime era. The data is all pointing to the same level of consumer crises that we had in 2007, 8, 9, and then 10, 11, post that. Although the numbers start to come down after that because those that are written off don't show again, do they? They're written off. All right. And the last link I'm going to send you is the delinquencies on all other consumer loans. So not credit cards, not all, well, it will include autos, this one. Not credit cards, not consumer loans, but all other consumer loans. It's a different category. And this is now at quarter 1, 2008 levels of 2.6%. But it's heading higher very, very fast. Okay? It reached at a peak 3.5 in 2009-10. We are 2.6% now, and it's rapidly increasing. Again, I'll send you the link. You can look at the chart. You can open it up, put it on maximum period, and then it will show you the ups and downs over 30 years, and you'll see where it's headed. It is not good. So this is Saturday, all right? I'm giving you all these stats because they're so important in telling you what is happening within the economy. CNBC, Bloomberg, Reuters, FT, Wall Street Journal, none of them are going to tell you this information. Not in a clear and obvious way and linking it to what's happened before. They might throw the stat out there, but they're not going to tell you what it means. The purpose of this site is to explain to you in as simple terms as I can what it means. And all of these links I've sent you today and all of this data I've given you today is heading one way, okay? The consumer is tapped out. So as I've said to you throughout this week also about the tariffs cannot be passed on. They cannot be passed on, okay? It's not going to happen because the consumer just won't buy. He'll find something else. He, she, they'll find something else because they're not going to pay 15% extra. So that's going to be absorbed in the chain, the distributor, the importer, the retailer, and back to the exporter. So all of those parts of the chain are going to make less margin because they're going to have to eat some of those tariffs, okay? And if they have less margin, what does it do to the S&P retail? What does it do to the S&P importers? They start to contract, okay? So you're seeing a stock market blow off at the moment, and that's what it's called. It's called a blow off. It's the last mad dash before the crash, okay? Happens in every boom, happens in every boom and bust. You get a last minute blow off where for some reason, and it's very sad, ordinary investors, FOMO comes into play, fear of missing out, and they come rushing in because they see it moving 6-1, 6-2, 6-3, 6-4. They come rushing in. Who's getting out? The clever people. The serious investors are getting out the back door off the back of those coming in, and those coming in are then left holding the baby. It happens every time. Okay? So please don't get caught in that FOMO rush because it's very sad to see people's pensions and their investments get hurt right at the end of a period when, to be honest, none of the logic said go in. All of the logic says the S&P is now valued at what, 30 times earnings, and what's the future? We know what the housing market is doing. We know from the credit cards, we know from the consumer loans, we know from the auto loans, we know what's happening in the economy. So why would you now rush into the stock market? You may miss 100 points, 200 points, so what? It's honestly not worth the risk, because when you do a risk reward analysis, you think, okay, from 6.4, what is the upside? Maybe 6.6, maybe 6.7. What's the downside? My world, 2,000. But that's going to take a while, and it'll take steps to get down there. But that's where I see it in the end, because of what is coming, and we've talked about it on the macro side. Okay, so thank you very much. Boring stat today with lots of stats, but they're interesting because they're all leading indicators. Again, you're not going to see this in the newspaper because the newspaper is not news, it's old. It tells you what's happened. We have to see what's coming. Okay, so thank you very much. Enjoy the weekend.